welcome. Today we're going to be breaking down the new SEC climate-related disclosure rules, covering what companies will need to disclose, the attestation requirements, key changes from the proposal, when companies need to start complying, and we'll leave you with some practical takeaways. I'm Desiree Carroll, Director at the Center for Audit Quality, and with me is Anita Chan, Partner in the Department of Professional Practice at KPMG and former Professional Accounting Fellow within the Office of the Chief Accountant at the SEC. Welcome, Anita. Very glad to have you with us today.
Hi, Desiree. Thanks so much for having me.
So, Anita, maybe before we even get into the details of the rule, perhaps you could share a little bit more about your current role at KPMG and your time at the SEC.
Sure thing. I like to say that I work for KPMG's multiverse in the sense because I have multiple hats that I'm wearing at the moment. So for one part, I'm a traditional financial statement auditor. On the other side, I also serve ESG clients where I primarily focus on the attestation work. So think about GXG attestation. And also I serve ESG clients in the advisory capacity as well. And then on the side, I support our national office, as you have referenced in my title, where I provide technical accounting consultations as well as work on attestation methodology developments within the firm. I think certainly I am very grateful for the time that I had at the SEC as a professional accounting fellow. Spending 2 years there really opened my eyes and have a heightened appreciation of sort of the work that the commission put together in support of the investors, as well as the broader ecosystem of financial reporting, as well as accounting as a profession. And I was fortunate enough, right, during my time at the commission, I participated in the proposal rulemaking process as it relates to climate-related disclosure rule. So certainly near and dear to my heart now to see that it's, kind of being finalized and adopted. So excited to be here to talk more about it today.
That's great, Anita. Thanks for sharing that with us. So, something else I actually think maybe we need to touch on before we get into the rule is we know the climate rule is being legally challenged. And on Friday, the US Court of Appeals for the Fifth Circuit granted a temporary stay of the rules. So while, I don't have a legal background, my understanding is that the stay keeps the rule from coming into effect, but whether the stay remains will depend on the next steps in the process because related suits have been filed in different courts. One of the next procedural steps is a lottery to determine which court will hear the matter. The different suits will be consolidated and heard by one court. If the matters are consolidated before one of the more conservative courts, it's possible that the court will decide to keep the stay in place until the litigation is resolved. However, if the matters are consolidated before a more liberal court, that court could lift the stay, which would put the rule back into effect. And I think there's also some uncertainty as to whether the stay only applies to the companies that filed the suit or to all companies. So a lot of unknowns at this point. How do you see all of this impacting how companies should think about preparing for the rule?
I mean, Desiree, I first off echo your point, not a lawyer here. And I do think it's probably a unique situation where the commission is kind of being challenged on both sides of the rules. With that said, I think especially for certain larger accelerated filers or larger corporations that have to comply with the required disclosure if it takes into effect as soon as fiscal year beginning in 25. So think about January 1st, 25 calendar year. Having sufficient time to really prepare for these requirements is going to be critical. So I think applying sort of a wait and see approach is not necessarily the most effective strategy here. And especially to your point, there's so much uncertainties, including, when the courts might settle. So it's a little bit tough to just kind of wait and have a cutoff point of how long are you going to wait for?
Yeah. No, that's helpful. So maybe then moving on to the rule itself, let's start with the regulation SK requirements. At a high level, what are some of those disclosures that are going to be required?
Sure. I think, what's interesting to me is that I would say a lot of the key components are still retained from the proposal. Certainly there's modification, right, nonetheless, to take into consideration and address some of the commenters' concern during the proposals phase. But largely speaking, specific to the regulation SK requirements, I'll break them into two parts. The first one is what we typically call the TCFD-like disclosures, and that stands for the Task Force Related Climate-Related Disclosures. And that's sort of, I would say, common language these days in the ESG or sustainability reporting landscape. So that serve, I think, is a helpful start where the Commission retained most of the requirements that mimic after the different pillars that the TCFD has set out, which includes governance, strategy, risk management, as well as metrics and targets. And I think for each one of those, right, just to give a little bit of a flavor, so think about the anchoring of this as a disclosure requirement as to how the company is having governance over particular climate-related risks that are deemed to be material to the company. How do they manage those risks and ongoing identification of it, as well as then what are some of the strategy that's going to be used to address those material risks. And finally, we'll talk a little bit more about that in the part 2 piece of the regulation SK requirement, but what sort of metrics and targets would be helpful to a reader or an investor to understand what those climate-related risk and transition plans might be. So with that sort of teeing up for this part 2 of the requirement, and that's the greenhouse gas emissions requirement. So certainly in the proposal, the Commission has suggested a requirement of scopes 1 and 2 and potentially scope 3 emissions. And those are common terminology used in the greenhouse gas space, where scope 1 and 2, just to quickly level set, is sort of the company's own emissions, whereas scope 3 focuses on the up and down value chains emissions related to kind of supplier, vendor, as well as downstream to the customer. And I think a lot of the comments, and probably many of you saw in news articles, right, scope 3 was very contentious. So come final, the Commission removed the requirement for the scope 3 greenhouse gas emission disclosures. And further, they added a materiality qualifier in there to kind of specify that you have to disclose scopes 1 and 2 emissions only if it's deemed to be material for your specific company in terms of making it being decision useful for an investor. So I think those are sort of a quick high-level description of what is required by the regulation SK.
Thanks, Anita. So, you mentioned that companies are going to need to disclose their greenhouse gas emissions. Maybe you can go a little bit deeper there. What are some of the GHG specific disclosure requirements that companies might need to make?
Certainly. So, maybe a good clarification point as well, right? The Commission, also similar to the proposal, has done a multi kind of tiering approach, right? Not only, which we'll talk about a little bit later, of the timing is tiered, but it's tiered based off of the level of filing status. So specific to greenhouse gas emissions, that's applicable to large accelerated filers and accelerated filers only. And specific to that, so I mentioned the scope 1 and 2 disclosure. So they need to include that as well as certain, what I would call, related methodology and contextual information. So what the Commission have done in the adopting release, which is similar to the proposal, was a reference to greenhouse gas protocol. That is currently a common framework that many companies are already utilizing in the voluntary reporting landscape to, as a methodology, basically think about a standard or a framework for how to calculate such emissions. So the Commission referenced to this greenhouse gas protocol and allows for flexibility for the company that has to prepare and comply with the requirement to utilize that framework to calculate with some elections that are allowable within the Commission's requirement to say, for example, which boundary might you use to measure and calculate the greenhouse gas emission, as well as certainly describing within sort of like, think about the notes to the financial statement, right? Like a qualitative narrative of what are some of those judgments and decisions that you decide to use as you come up with the scope 1 and 2 emission calculation. And then if you, for example, decide to follow suit as the recommendation of utilizing a greenhouse gas protocol, then disclose that. If you use something else, which is perfectly acceptable too, you just have to disclose what it is that you chose. I think it was an interesting observation from my end where in the adopting release, the Commission was very deliberate to focus on not adding a burden or a cost to requiring some of these disclosures, and really anchor to what is very commonly seen in the current marketplace under the voluntary framework already. So like the greenhouse gas protocol that I mentioned is widely used. And then more so the Commission is focusing on bringing consistency and comparability amongst the preparers to have this type of disclosures available to the marketplace.
That's helpful. And so my understanding is not only will they provide these GHG emission disclosures, but there's also going to be an assurance requirement associated with that. Could you tell us a little bit more about that?
Sure thing. So, certainly a CPA, that is an important piece for us to look into. So you're absolutely right. And consistent with sort of the proposal, the Commission retained the requirement for what we start out as is limited assurance level of assurance over the greenhouse gas emission for scopes 1 and 2. And then eventually there'll be a phase-in period that brings it up to what we call a reasonable assurance level. Just in case for the terminology purposes, right, limited assurance is more what we call a review level. So think about currently as an auditor, you might review a company's 10Q quarterly filing, whereas reasonable assurance is more at the examination level. So think of the audit of the annual Form 10K. So subject to that limited assurance within that requirement, it was quite interesting because the Commission has a lot of details around there, what I would like to call them as guardrails of who could qualify as the service providers in these cases over the greenhouse gas emission assurance. I think there's a lot of emphasis on the independence requirements, as well as having the requisite knowledge, skills, and ability to do so. And then it also provided some guardrails as to, for example, if you issued a report, there are certain consent requirements that might be related to it that the auditors or assurance provider, as well as the company, need to be aware of. Certainly, the assurance requirement is more focused on the large accelerated filers and the accelerated filers only for the disclosures. So it's not subjecting everybody to that requirement.
Okay. Well, that's helpful. And actually continuing on the topic of attestation engagements, one question that comes up quite often is, can the same firm that performs the company's financial statement audit also perform the assurance over the company's greenhouse gas emissions?
Yeah, short answer is yes, absolutely. I think, many may not immediately think of your financial statement auditor as a greenhouse gas emission, for example, assurance provider, right? But I would say, interestingly, especially outside of the United States, it's very common for companies to select accounting firms as their service provider for sustainability assurance. And then commonly, usually within that subset, turns out to be their financial statement auditor as well. And I think maybe just to highlight a few reasons or benefits for why a company may want to choose their external financial statement auditor as sustainability assurance provider. I think first of all is there's a base knowledge that your financial statement auditor already would have of the company, right? In order to execute on the financial statement audit, you have to know the business well, you have to know the company well. And from the knowledge of the company's kind of financial information as well as business operations, you will naturally get exposure already to some of the company's non-financial type information in that process. And that makes the further kind of integration or understanding, which we'll touch upon a little bit more about specific to this rule, why the integration is important between financial and non-financial information. And there are some certainly synergies there, right? There's also another factor to consider is because your auditors are already more familiar with the company's processes, systems, and people, recognizing certainly sustainability information don't follow the same process or always come from the same system as your financial reporting information. But nonetheless, having that awareness and sometimes do have overlap. For example, think about a procurement system or fixed asset ledgers that could be relevant to greenhouse gas emission. That's certainly worth highlighting as a potential synergy and benefit as well, right? Maybe last thing I'll leave for the audience as a food for thought as it relates to this topic is the staff actually has a point within the adopting release, and I'll say is sort of hidden because it's in one of the footnotes, 1391 to be specific. But they actually highlighted in there that if an independent accountant who audits the registrant's financial statement is also engaged to perform the greenhouse gas emission attestation for the same filing, the fees related to it would be considered as audit-related fees for classification purposes in the proxy. And I think that's a very helpful clarification point that the commission decided to put it in, because I think it really helps, for example, audit committees as they pre-approve services, or management to think about it, how do we want to frame an understanding of why an auditor would be beneficial or suitable to perform such assurance work as well.
Yeah, no, that's super helpful. And I'd also noted that in the footnotes. I was glad I was reading all the footnotes. So actually, even to one of your points earlier, in our most recent CAQ analysis of S&P 500 companies' ESG reporting and assurance practices, we noted that of the companies that obtain assurance from an accounting firm, 90% of them use the same firm to perform both their financial statement audit as well as the assurance over the ESG related information. So it kind of ties into what you were seeing there too. So we've spoken about what some of the regulation SK disclosure requirements are. Can you also tell us where these disclosures are going to need to be made?
Sure. So if you think about a Form 10K, this is what we would call is going to the front part of the document, right? So think of where your existing MD&A is for the document. It would be in a separate section related in that vicinity, for example, either within or next to the MD&A, and call kind of climate related disclosures. And I think on that point, when you speak of location, right, I think it's important to highlight to our audience that just like any other information that's currently disclosed in a Form 10K within the, let's say, MD&A section, there are disclosures and control procedures requirement that the companies are subjected to. So think of any of these requirements that we sort of just talk about, the TCFD-like disclosures, as well as greenhouse gas emission prior to and during the assurance requirement. It still requires the registrant to have robust and effective DCP, what we would call, over that information. And then certainly part of it is it's going to be subjected to companies' management officer certifications as well over that information.
That's helpful, Anita. Thank you. So we've spoken about that. We've covered sort of that SX part of things, the SK part of things. Sorry. So let's move on to the regulation XX requirements, which cover the financial statements. And at a high level, what are some of those disclosures that are going to be required, and sort of where and how are companies going to need to report that information?
Yeah, so I think this one, it's interesting because, certainly, right, disclosures in the financial statement is perfectly within the requirements and authority and wheelhouse of the commission. So certainly not a surprise when they came up with that in the proposal, and that they retained some of that requirement come final. I think it would be remiss not to address the point that certainly a 1% disclosure threshold, for those that might be familiar with the proposal, was introduced and received a lot of feedback, to say the least, from the preparers community as well as others within the ecosystem. And I think you will see pretty clearly in the adopting release that the commission seems to have put a lot of thought through it, right? Like the staff really analyzed and talk about why ultimately they still decided to retain a 1% disclosure threshold specific to this SX notes to the financial statement disclosure requirements. But they did make sufficient modification, in my personal opinion, that I think would help alleviate some of the previous kind of concerns or confusion, let's say, with the proposed rule. And now is a little bit clearer. So maybe let me just dive in sort of what that entails, right? Specifically, first with the location, it's going to be in the notes to the financial statement that these type of information, I'll call it this way, needs to be disclosed. And largely there are 4 buckets that I will characterize them in. The first 2 is more quantitative in nature as a starting point, and is really anchoring on impacts from specifically severe weather events and other natural conditions. This is one that is a term that received quite a lot of questions during the proposal time as well, and the commission retained. And explicitly, the commission and the staff continue to say they're not providing an exclusive or exhaustive listing of all that could fall under what it means to be a severe weather event and other natural condition. I think they wanted it to be principles-based because recognizing, to be quite frank, right, what severe weather events in one region could be very different for another, as well as different companies operating in different industries, right, could have different implications from these type of events. So they have provided, I think, a good number of examples within the release as well as in the final rule text, such as, wildfire, tornado, and things like that for companies to think about. But I think ultimately, as a practical step for the companies, they will need to think about how they want to define it and set up a policy of interpreting what are severe weather events and other natural conditions for them. And from that point on, they will then have to quantify in what I will call as tracking expenditures as well as capitalized costs related to these severe weather events and other natural conditions. And to the extent it exceeds the disclosure threshold of 1% of the benchmarks are interesting. I'll give that in a little bit, as well as exceeding certain de minimis threshold that they have to put in, then those are the quantitative disclosures that need to be included in this note to the financial statement. Now, I danced around the kind of threshold a little bit because for those who might be familiar in the proposal, they have sort of a line-by-line analysis requirement. They have taken that away now come final, said that's a little bit too burdensome. Probably more direct is to focus on actual transactions that have been recorded to the financial statements. From there, take what was, again, impacted by the severe weather events and other natural condition. On the expenditure side, so think of your P&L, your income statement. If it exceeded in aggregate 1% of the net income or loss on an absolute basis, and it also exceeded a $100,000 de minimis threshold, you will have to disclose that impact. In parallel, on the balance sheet, if all those impact from a capitalized cost perspective related to severe weather events and other natural conditions exceeded a 1% compared to your absolute value of stockholders' equity on the balance sheet side, and then also exceeding a $500,000 de minimis threshold, you will have to disclose that aggregated amount as well. So I think it's really helping draw connectivity for someone to understand what that quantified impact is if you have to address, for example, a roof that got damage in your warehouse from a tornado or severe rain and flooding that damaged inventory within a distribution center, all that replacement cost and related expenditure, that's what it's intended to capture. Then I'll move on to the kind of third and fourth item related to the notes to the financial statement. The impact from severe weather events and other natural conditions is one. If it has a material impact to the estimates and assumptions used in the financial statements, you will have to disclose that qualitatively, right? To say if it, use an example of estimated useful lives, what's impacted because you think it's going to be retired soon by the severe weather events impacting the area. That's one thing you'll have to disclose. The interesting piece of the other linkage is if in the SK disclosure that we talked about earlier, you have disclosed any sort of material climate related risk and transition plans associated with it, and it has a material impact to the estimates and assumptions used in your financial statements. So let's say if your projected financial information for, let's say, revenue has something related to it, that's expected to be a qualitative disclosure in this area as well. Lastly, specific to sort of a specific category to transition risk. So again, back to your SK related disclosure, if you have said you have a material climate related risk, then you have a transition plan that you decided to put in place to address that risk, and a material component of that transition plan or strategy to do that is by usage of carbon offsets and what they call renewable energy credits. You will explicitly have to disclose that in your notes to the financial statement, the amount of expenditures or capitalized costs that you have associated with these carbon offsets or renewable energy credits. And then qualitatively, and I think this goes to all the sort of four categories that I have just described, what the commission continues to anchor a lot to is the contextual information. It was a requirement in the suggested in the proposal and now also captured and finalized rule is to say, tell us more about how you have come to put together this note to the financial statement, significant judgments that was put into place, any estimates, policy decisions. How did you come up with the aggregated impact from severe weather events or other natural conditions or implications to your estimates and assumption? And again, sort of that renewable energy credits or carbon offset usage. Maybe the last point specific to regulation SXL mention is because of many of the feedback that was provided as to, well, how do I know if the entire amount I spent on fixing the roof to my warehouse is attributable to maybe climate-related events or, that's the old term, right? Or severe weather events and other natural conditions. The commission I thought was helpful is in this final rule, introduced a attribution principle. What it really means in essence is if the cost or expenditure or capitalized cost was incurred significantly driven by severe weather events or other natural condition, put the entire amount into this note to financial statements as a quantification process. So I think it's important as you're tagging as a company, right? If you start thinking about how do you tag certain transactions, either, for example, by vendor, GL account, or invoices, being able to quantify and include the whole 100% of that amount into this quantification assessment, I think provides some clarity as well as consistency across different issuers preparing this note.
Thanks, Anita. So at this point, we've spoken about what needs to be disclosed and where or how it needs to be disclosed. Let's talk about timing. When are companies going to need to start reporting this information? What does that look like?
It's a great question, and thanks for putting it to the next slide, because certainly it's really hard to talk about all the different requirement dates that's phased and layer without maybe having something in front of us. So I think this chart hopefully captures it well, right? The earliest it starts for large accelerated filers is starting fiscal year 2025. So it could impact certain large accelerated filers with calendar year end December 31st at 1/1/25. This starts to kick in, right? So if you think about the financial statement information that we just talked about, you have to start tracking transactions that take place and could be impacted starting 1/1/25. And then it has other disclosure requirements that kicks in starting in 26 and then phased approach with 27, 28. And I thought they were very thoughtful in terms of the staff and giving extra time for some of the more forward-looking disclosures that are under SK that we briefly touch upon, right? But the forward-looking kind of transition plan, if you have scenario analysis and things like that, those would come in with 1 year lag. Certainly the gray bubble kind of landmarks over there, limited assurance starts to kick in 2029. Sounds a little bit far out, right? But if you think about it, getting processes and controls in place would take a long time. Similarly to the 2025 remark earlier, sounds like you have at least still, 8-9 months to go. But specific to the notes to the financial statement disclosure, those information will be subjected to your financial statement auditor's existing audit requirements. So think about internal controls over financial reporting that you have to put in place to design processes and controls that would capture all those information and then get it subjected to auditing. I think that is certainly something to keep in mind, that even though the timeline looks a bit spread out, might not be as much time as many might suspect there to be.
That's super helpful, and thanks for the graphic. I think that helps, just helps tie it all together. So Anita, we've covered like an overview of the rules at a high level. For those of you looking for a high-level written summary, maybe we'll drop a link to one in the chat. And then if you're interested in more information about the role of the auditor in climate-related information, we'll also include a link to a publication on that in the chat. So Anita, kind of with everything that you've shared today in mind, how are companies thinking, how are auditors thinking about advising clients as they start to prepare to implement the rules? I think you've touched on a few things, hinted at some as you've gone along, but perhaps you could elaborate on that for us.
Sure thing. I think, processes and controls is top of mind to me. I think certainly first is you have to digest the requirements, right? Like even trying to articulate it in a summary format, it sounded quite a lot and it took us a lot of time to talk through a lot of the nuance, which we didn't even get to cover all of them. So I think that's step one. And then step two is building out a robust process and controls framework to address that. And I think what, commonly we tell client as well is, if they decide to do the wait and see approach, to me, hope is really not a strategy, to quote a former, chair from the SEC. So I think it's important to keep in mind, because especially in particular for some of our large accelerated filers, they are not only subjected to the SEC's final climate rule. There are many other forces in place that, is not subject of our sort of webinar today, but it would be remiss not to mention, right, there's the EU CSRD regulation, which is a lot broader and far-reaching than the SEC's final climate rule. There's the California rule at play as well. So as companies are thinking about the interoperability and intricacies of other market forces out in there, be it regulatory related or even voluntary, if you think about rating agencies or investor, supplier, customer demands, for example, I think the time is now for companies to really get started on it. And so certainly as auditors, we have a role to play to explain, I won't mention all of it again, but certainly a lot of synergies between our skill set to audit financial statements, understanding kind of information, reporting, estimates, and assumptions, how that translate into sustainability reporting as well.
That's helpful. And so then, to maybe help us wrap up our discussion today, what are some practical ideas that you want to leave the audience with?
I think maybe I'll do it twofold, right? For our auditors today, similar to what I mentioned earlier, but really familiarize yourself with the rule as well as other rules and requirements that might be out there. So you could be a true advisor in helping talk through what the differences or synergies might be between all the requirements out there. Talk about, financial statement audit implication. I mean, that is really front and center. That's a requirement that in the note to the financials, you will have to look at that and you have to understand it, and really important to align on expectation. I think a important, useful tool that many may not often think about is the readiness assessment. Certainly with independence, guardrails, and all that is still permissible. So it's important to think about before the rules are actually effective officially, do some sort of trial run, understanding the processes and controls with your client, I think would be very beneficial. And then I think lastly, maybe moving on to a little bit for our audit committee audience today, in case there are any on the call, the governance requirements, right? We touched upon briefly about it earlier in the regulation SK requirement, but governance is an important pillar that I think resonate throughout in all the information that's being subjected to review. So having a policy and plan in place, and then really liaising with management as well as the auditors to think through about the readiness of implementation, and also, any sort of knowledge, skill set, upskilling that might be requisite to facilitate that oversight, I think would be a practical next step.
Thanks, Anita. Some great suggestions there for our audience. With that, Anita, thank you for participating today. And thanks to those of you who joined us for the discussion. We hope you found it informative.
Thank you, everyone.